Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. That's the SGX Nifty flat, which is interesting because the rest of the Asia is doing reasonably okay. Now, for last few days we've seen Hang Seng also. There's minor rally, but that gets sold into 0.5% higher right now. Ashwani Gujral, Mitesh, Thakkar, and Prakash Kaba with us. Good morning, Ashwani. If the SGX is right and we get a flat opening, is there a trade?
Well, good morning. Something does not seem right, which means that yesterday we should have rallied by the close when Europe was higher and nothing really was wrong with Asia, etc. But we decided to close at the lows. Now there are some humbug reasons. Kotak is falling because of stake sale, HDFC is falling because Parekh is resigning, etc. I don't believe that. Where are the long-term buyers? And closing at the lower end of the range, not responding to global cues, just means that EMs probably are going to underperform from here for some reason. So even if we do get a rally, I'm not interested in chasing it. I want to see if that rally starts to fail and we start taking out yesterday's low, and despite global cues, etc. being higher, we start to break down. So I don't think we are likely to respond to these global cues. Obviously, market, once it opens, will give you a bias. But yesterday we didn't close strong. If you leave out the banks also, even the rest of the market did not close strong. So that way, maybe a trip towards 11,250, 270 could be likely. And particularly, banks are looking a little jittery with those large banks not participating on the upside.
Okay. So what would be the contours in the Nifty Bank?
See, broadly, yesterday's range, whichever way it gets broken out, because yesterday was a fairly narrow range day. So you can say, 11,370, and maybe on the upside, yesterday we failed around 11,450, 460. So broadly, that sort of a range. Now it's a 50, 60 point band. So in case the market starts to come off with any sort of force, then you could have a large day on either side.
Okay, we have Mitesh, Thakkar and Prakash Gaba also here with us. Prakash, hi, good morning. You get a sense that there's more to go on the upside for the Nifty in the immediate term, or will the bulls have to be a bit more patient?
Good morning, Sonia. Well, what we saw was some kind of an exhaustion in the upper regions on the Nifty, somewhere closer to 11,430. And last week, we have seen the target of 11,505 being achieved. So technically, we have seen it looks like some kind of an interim top. I won't call it a top, but yes, it's not going up in a hurry. So if we do get a release, I think there will be shorting opportunities. Where is the support? I feel it can see a slide to 11,280 zones. That's the area I'm looking at. If it goes there and survives there, then we are into a trading range. But the basic trend is up as long 11,280 holds. That's the way I'm looking at Nifty. What about Bank Nifty? Well, Bank Nifty, I think, is very, very strong support in the vicinity of 27,715. That's an area, if it comes there, it's likely to find support. And if we get Bank Nifty rallies until 27,960 or even 28,000, if we do get one, which is difficult, then those will be shorting opportunities. But idea is where to, it's an open A, where does it go higher? Would I get a chance to short? I would look for one. Let's see where it goes.
Okay. Mitesh, good morning. Your thoughts on the markets?
Good morning. So I've been calling for consolidation for last few days, and I think that still plays out. The ranges are 11,350 on the Nifty, 11,470 on the upside, while Bank Nifty is closer to, I think Prakash just indicated the level 27,720 or thereabouts, and 28,100 being the upside range. So I think this consolidation might last for another few days. The indicator setup on the hourly chart still suggests that it's looking a bit tired after a good rally towards the early part of August. In case you break 11,350, we might get another 120 point kind of a dip, but I'm not very bearish on this market. Looks like consolidation for next 5 to 6 sessions, and then we might resume the uptrend.
Okay. Mitesh, is the Nifty Bank weaker than the Nifty?
I think there's some kind of churn going on in the Nifty Bank. I would say it's marginally underperforming. But I think, what is happening is that a couple of outperformers in the Nifty Bank are losing ground, and I think Ashwani is highlighting Kotak and HDFC Bank, and we have seen the corporate lenders like ICICI Bank, Axis Bank come into prominence. So I think that process will continue, and therefore, since the heavyweights would shed weight, I think it might underperform in the coming few weeks also.
Fair point. Let's discuss individual stocks then. Ashwani, what's on your list?
Just one more thing I want to point out, that there are a lot of macro cross currents. So it'll be possible to assess which macro current the market is latching on to. Is this EM underperformance, developing market outperformance, or is it crude? What is it? So that needs to be figured out in order to kind of confirm which way we are going. Having said that, NBCC is a buy with a stop of 73, target of 81. Infosys is a buy with a stop of 1400, target of 1475. Berger Paint is a buy with a stop of 325, target of 340. Bata is a buy with a stop of 995, target of 1040. And Tata Steel you can buy with a stop of 560, target of 585.
I just wanted to add a word to the macros you spoke about. If there is an EM underperformance, I would think there is an India underperformance within EMs. I think this current account deficit issue is not going away in a hurry.
Oh, absolutely. And not just current account, the way the inflation trajectory could move with the way the rupee is panning out, etc. All of that put together could create havoc in the near term. But NBCC seems to be a top favorite this morning. Prakash, you have it on your list as well. What else would you be looking at?
Yes, certainly. NBCC seems to look good, and we've seen a good base formation on Tuesday or so, and went up. I think it's heading to levels closer to 18. It's a matter of time. Stop below 71 on NBCC should be fine. I have Maruti. Maruti is trying to form a base. We could see an up move here. Down move that we have seen in Maruti looks to be getting over. Perhaps an up move should start back from here. Targets on the upside on Maruti is 9,300 plus zones. Stop below 9,100. I have two shorting ideas. I will go with Equitas. That is broken down, more of an exhaustion pattern here. Perhaps we can see a slide to around 135 zones. Stop above 142 should be fine. And JSW Steel looks weak, is running down. Looks like heading down to levels closer to 320. Stop above 335.
Okay. Well, with that, Mitesh, what are you trading? At least you don't have NBCC on your list.
So I have Berger Paint. I think that's made a fresh swing high. That's a buy with a stop at 324 for targets of 342. Amongst the pharma names, we've been bullish on most of them. Dr. Reddy's kind of comes in for the trading call today. That's a buy with a stop at 2300 for targets of 2450. And Godrej Consumer, I believe that there's a negative fundamental report, but the short-term charts are slightly positive. So a long trade with a very tight stop at 1314 can be taken for targets of 1375. And I have two sell calls as well. Tata Power has made a fresh swing breakdown, so that's a sell with a stop just about 68.5. Look for targets of around 63.
Well, it's still the tail end of the results season, so we have some numbers that have trickled in over the past 24 hours. Among them, Mishra Dhatu Nigam or Midhani Industries. That stock has rallied almost 50% from the time of its listing. And, well, to put it in perspective, it's also down about 26% from its recent highs in April. Earnings are looking very good, actually, and supported by both sales as well as EBITDA. Sales is up about 21% and operating profit up 31% thanks to an improvement in margins. We're joined by Dinesh Lekhi, Chairman and Managing Director of Midhani. Good morning, Mr. Lekhi. Thank you very much for joining us. Well, first up, were you advantaged by a low base? Otherwise, these growth numbers look very good. Can you maintain 21% for the full year?
See, I think typically in Midhani, we make the production cycle about 10 to 12 months. So first quarter, always numbers are a little less compared to second and third and fourth. So I think this every quarter, the improvement is expected. And that is one reason we feel that in the subsequent quarter, the performance will be at least as good as first quarter or maybe better.
Okay. Can you give us some numbers, Mr. Lekhi? Your order book currently is a little under 660 crores. What kind of fresh orders have you seen? And can you break it up for us, within defense, space? Where are you seeing the orders coming from?
See, the good news is that even recent in the Independence Day, Mr. Modi has announced a lot of space programs, which is basically putting the man into the orbit. And with that, space programs are getting sanctioned, and we hope that orders are going to flow from space more. That is number one. Our current order book also, we got some orders from energy sectors, both from thermal energy as well as from nuclear energy. So currently the order book is about 700 crore and another 300, 400 crores on pipeline. The order book is good at times to come.
Okay. Well, I still want to persist with your numbers, Mr. Lekhi. Your net profit is about 12.8 crores, right? 13 crores. Last year, your profit was 125 crores. The year before, it was 120 crores. FY16, FY17 is what I'm referring to. You're a distance lower. Can you really post 40 crore in each quarter, second, third and fourth?
Yeah, that's typically I'm telling you that what happens is that we are basically 10 to 12 months production cycle. So each quarters, the fixed costs get covered and the way we try to account it. So subsequent quarter, the top line gets start improving because more and more production starts getting utilized because of the production cycle. And obviously, the bottom line also gets improved because we already have taken care of all the escalations, especially salary, wages, and raw material. So the improvements happen in second, third, and fourth. If you see the last year's quarter-by-quarter performance, you can find this trend happening on second, third, and fourth quarter.
And you said now, sorry, go ahead. Sorry.
Yeah. The other thing which is also is there that in the first quarter, the cobalt, which was at a peak of 95, has tanked to about $65. So we are going to get advantage in subsequent quarters because the cobalt volatility has gone on to the downside side. So this is another issue which will happen where the profitability is going to increase because the raw material price, some of the price, especially the cobalt, has gone down.
Okay, no, I wanted to ask you, you said your orders at the moment are around 700 crore and you have a L1 perhaps in 300 crore or thereabouts, you're expecting to get it. Now, your annual revenue run rate is about 700, 800 crore. So you just have orders for a year.
No, this is what I'm telling you. Last year also, about 54% orders we got in the same year and got it completed. And this type of production cycles that we are improving now from 12 months to 8 months, 9 months. So some of the production will be completed within this year. And the way the orders are going to come, this order book will be always 1 year or 1 year. But it is not typical other different sectors where the production cycle is 3 years or 2 years. We are having traditionally about 1 year type of orders.
Okay, so this 300 crores of new orders that you spoke about, which are in the pipeline, which segments are they from? Is it largely from defense? And what kind of margins would you enjoy on these orders? Would it be higher than your average margins?
This is mainly from the space and the energy. And the energy generally are competitive sectors where we get average margin. But from the space sectors is a high margins product because they are very, very high quality and high niche products are there. And especially from the titanium, which is our high margins product, is more and more orders from the sector comes. Okay, so since more and more orders are coming in from high margin products, can we expect you to do better margins than the 28% that you clocked in FY18? I will say it will be at least maintain at 28% and maybe little 1 or 2% here. The reason is that we could not produce much in first quarter of the titanium, and the more titanium portfolio will increase the margin. But we are also making the steel, which is on a low EBITDA margin. So I feel it will be maintained.
Last quick question. You are working on 2 new facilities, right? When will they come up and do you have to take debt for it?
See, we already are there on Rohtak plant. Already some production is started with Hyderabad facility. So we are starting clocking about revenue of over 10 crores every year from this other business. Shifting for the scale-up productions, I think that maybe this year financial year end will start working on Rohtak. The other location, Nellore, we are on the still in detailed project report. Maybe next year the election and project activity will start.
Okay. All right. We'll leave it at that, Mr. Lekhi, and check out on how your expansions will pan out at a future date. Thank you very much indeed for joining us. Well, Ashwani spoke about how the macros seem to have a niggling worry, and that's what we are going to discuss now. There are 2 major macro cues that we have to discuss, or maybe 3. The Reserve Bank has come out with minutes of its monetary policy meeting, so we would like to know whether they sound like there is a series of rate hikes or none at all. Secondly, of course, we have the niggling trade deficit worry and whether it will expand into something which can, torpedo the macros. And third, of course, the global scenario. Samiran Chakraborty, Chief Economist at Citi, joins us now. Good morning, Samiran. First, the latest news. the minutes of the meeting, are they also ran reflective of this statement, or are you reading any more?
Well, Lata, for us, the important question was to understand to what extent the MPC members felt the commitment to move to a 4% inflation target versus utilizing the band around it. It appears that majority of the committee members felt that achieving the 4% mark is very important, and we felt that there was some kind of an urgency to get to that 4% mark. And that's why the committee almost indicated that the recent slowdown in the CPI numbers will be ignored, and they will look at the pickup in the latter part of the year, which worries them the most. The reasons for the rate hike were pretty obvious: comfort on growth, MSP-related worries, inflation expectations. Those were quite standard, but what was really interesting to observe is MPC's commitment to get to that 4% target as soon as possible.
Sure. Samiran, hi, good morning. Of course, all of that is now in the past, but going forward, the key question is whether the Reserve Bank will use interest rate hikes to defend the currency, because the common view is that a significant depreciation in the rupee, adjusting for oil prices as well, would likely cause a policy response, if it leads to upside inflation risks. What's your own view on that?
Yeah, it's actually quite ironical that what difference a fortnight makes. On August 1st, if you look at the minutes of the meeting, it almost appears that the global uncertainty gave a mild dovish undertone to some of the members' comments because they were not sure how it's going to impact growth negatively. And two of the members actually mentioned that the need to maintain the neutral stance at this juncture was primarily because of the global uncertainty. In 15 days, the global uncertainty seems to be playing the other way, where the inflation risks are now more than the growth risks. But having said that, we think in today's juncture, it's not likely that RBI will be using interest rate policy explicitly to manage the exchange rate. But on the margin, given where we are, the undertone might be a bit more hawkish because of the external developments. We need a significantly divergent INR performance versus rest of EM for us to consider interest rate defense of the exchange rate.
Okay, Samir, and more interesting really is your report on the current account deficit. You are now forecasting 3.2% if this is the way the import numbers come. Take us through that, the way you are forecasting numbers, and what does that mean therefore for the rates? Does the RBI actually have to use rates to cool the economy so that imports come down?
So if you look at the thought process around the current account deficit numbers, we are working with about 75 average oil price for the year, which is our house view. We have upped a little bit our gold import numbers from about 30 billion to about 36 billion because of the recent trends showing a slightly higher gold import number. What structurally causes us concern is that the components of trade deficit, which are imports rather, which are increasing, is quite wide-based. It's in consumer goods sector like electronics. It's also in capital goods sectors like machinery and transport equipment, etc. So everywhere almost we are seeing a significant uptick in import demand, which could be connected to some extent the recent strength in the domestic economy, but could also be showing higher import intensity. So at this point, it's difficult to distinguish between the two. But if we go with a run rate of about $17.5 billion of monthly trade deficit from here, then we will probably reach about $88 billion of current account deficit for the full year, despite service exports being much better than what we had anticipated, and we had upped the numbers on that front as well. So 88 billion will be roughly about 3.2% of GDP of current account, And that's something which will clearly play in the policymakers' mind on how to structurally bring it down. Can cooling down the economy help? Yes, on the margin it helps, but this is more of a firefighting rather than a structural solution to the problem. The structural solution to the problem should involve a more holistic approach towards how to improve the export performance and how to reduce our import dependence. That will require a more solid work on more real economy factors rather than just the blunt interest rate tool to manage it.
Sure. So, as you rightly pointed out, in 2 weeks or 2 or 3 weeks, a lot of things have changed. Up until now, the base case view was that monetary policy would be in a pause mode. But since the external factors have changed a lot over the last 2 weeks, do you see the probability of policy tightening increase, at least in the next policy, in the October policy?
We are working with a scenario that given how the different MPC members sounded in the minutes, that they're going to wait a bit to see the impact of these front-loaded rate hikes. So maybe October we don't see the MPC move much, but we have penciled in another 25 to 50 basis point rate hike in the latter part of the year to mainly accommodate the view that is coming from the MPC that they're very keen to get to that 4% mark. So earlier we were working with the assumption that anything between that range 4 to 5 would probably be acceptable to the MPC, but now it appears that the MPC will not like to tolerate even this deviation from their 4% medium-term target, particularly when this is a 4-year term of the MPC which ends in 2020 September. So if by 2019 also it does not come to 4, then for majority term of this committee, inflation will stay much beyond their target range. So that could prompt a little bit more tightening than usual, and that's why we are baking in 25 to 50 basis point of more rate hikes at this juncture. Not so much because of the currency defense, but more because of inflation.
You've moved a distance, haven't you, Samiran? When we took the vote in the MPC of whose you are a member, the CNBC TV18 MPC, you were only expecting a 25 basis hike this year. That hike already came on in the policy day, August, but now you're expecting a further 25 to 50. So that's quite a distance you've moved after the minutes and the current account deficit. Okay, final question. Where do you see rupee settling then?
So we have taken a call that the trading range for the rupee is now likely to shift from 67.69 to about 69.72. This is still a function more of how the rest of the EM moves. Our view is that the EM weakness could persist for a while, and if that's true, then rupee will also be a bit of under pressure coming out of that. We are not explicitly building in any view of rupee underperforming the rest of the EM, but at this moment it appears that the current account deficit shock, or rather the trade deficit shock, has spooked the investors a bit on INR. So we will have to see the next couple of prints on this. There is also the expectation that as oil prices have cooled off a bit, that should start showing up in the trade deficit numbers. If that happens, then possibly it's all good. The other thing that people are observing is the fiscal deficit trends in India. So if we don't see any significant slippage over the next few months, then the worry on both trade and fiscal front will be lower, and that can cool off the pressure on the currency. But otherwise, we see the trading range now settling around 69 to 72.
All right. Thank you very much, Samiran, for joining us with your thoughts. So, of course, crude will be the trump card, but worries clearly on the current account deficit. And that's leading to expectations of further hikes.
Yes,
I mean, besides, of course, the MPC, as he says, is now at the last leg of its term, last 2 years. So probably if it is serious about 4%, then it has to be hawkish.
Absolutely. So it's more the MPC comments rather than the rupee which is making him believe that, a rate hike perhaps
No, that's not true. Did you read his report? 3.2% current account deficit is as much a reason.
Okay. Yeah, current account deficit, of course, is a bigger worry as well. No taking away from that. But let's get back to talking about stocks now. Sanjeev Bhasin of IIFL joins in to discuss some fundamental ideas with us. Sanjeev, hi, good morning. The stock of the week undoubtedly is Sun Pharma, up almost about 12% post its numbers. You think there's a turnaround story playing out here? And at this level of 600, how does the risk-reward look?
Yeah, good morning. So, Sonia, Sun has been, as a disclosure, one of our contrarian picks, and it's been 1 year coming. It's been a laggard, but we've stood by our conviction. So, ITC, Sun Pharma and Ultratech are three outperformers in this rally. We have a target of 750 on Sun Pharma, and we remain extremely bullish. We think the weakness in the rupee should ideally be played out not by IT but by pharma. So you can make a basket, but Sun is going to lead from the front. And like we said, 750 is what our target is, maybe by March of 2019.
750 is the target on Sun Pharma. Sanjeev, good morning. Are you a buyer of Kotak Mahindra Bank after the correction, or you think perhaps some more is needed on the downside?
No, for us, this is an avoid. Kotak Bank, HDFC Bank will be avoids. We are looking at the broader market. ICICI, SBI, Bank of Baroda, Karnataka Bank, RBL Bank, IDFC Bank. We want to make money, and that is where the money is. So if our Diwali target for Bank Nifty is 30,000, then these are the banks which are actually going to be giving you higher beta. So for us, those defensive high-price stocks, Kotak and HDFC, which is now having problems with a legacy issue, should be avoided.
Okay. Sanjeev, I have more questions for you on the banks, especially since banks like Axis have run up, what, 15% this month? And, you know, the month is not out. It's only half the month. So I'll come back to you on that. We'll just do some FNOQs. Amit Gupta of ICICI Direct has joined us. Good morning, Amit. Which stocks are you trading?
See, we are recommending Amar Raja batteries and Berger paints to our clients from the mid-cap space. Now, the reason being that Exide has already given 50% in return in the last, in 2018 from 200 to 300. And Amar Raja battery during this period, if you look at around the mean price of this stock, it has remained near 800 levels. In fact, it was a very good performer in 2013 to 15. It has just spent time. I am not seeing a major weak stock, but it has just spent time around 800 levels. But if you look at the FNO setup, we had seen very high short build-up in the stock, but the thing is, it was not falling beyond 750 levels, and that is why I think once this momentum is coming in Exide, I think some catch-up will come in Amar Raja battery also, and that is the reason. If you look at the last rollover, we had seen 15% cut in OI, which was clearly a short covering pattern panning out. So I think in this rollover also, from August to September, you will see further decline in open interest, and that will be further short covering pattern. So I think from these levels, the downside seems to be very limited. The results are already out, though it was not a major spark in the results, but I think it was not also major disappointing. So as the stock has already taken a lot of adverse news flows right now, it is due for a move on the higher side. So I think 940 is very much due on the higher side. So we are targeting this for this particular series and then for September. Now coming to the another one is Berger Paints. I think this stock among the paints was a laggard little bit. It spent a lot of time near 280, 300 levels. Once this move has come in, if you look at the open interest, the leverage is still very low, though the stock is near the life high levels. So I think this leverage has to pick up, which has already started. If you look at yesterday's session, there was a good significant build-up of positions. I think clearly the long positions are coming in, and that is why the momentum should start in Berger Paints. It may continue till this expiry. It can continue after that also. So I think we are targeting 375 on the higher side, and my assumption is it should not come below 300 now.
Okay, that's two stocks. Amit, good morning. There's also a trade that you have on Infosys.
Yeah, from the Nifty perspective, I think that some of the Nifty stocks which are beneficiary of rupee depreciation, clearly IT and Pharma, and Infosys, which was a little laggard in comparison to TCS, because from January 2018, TCS has moved up by almost 35%, but Infosys has moved up only by 15%. So I think that catch-up has to come up now. And if you look at Infosys from January till June, it remained near 1200 levels, and then this move has started where the open interest is declining and the stock is moving up. So that means the stuck up, very rigid short traders also are closing their positions, and that is why every rollover is seeing a lower rollover of shorts, and that is the reason I think the stock is in momentum. And I think if somebody can buy the call options of August series also, that can also work. Now it has just crossed 1400, but before that it spent almost a month near 1380. So I think 1380 is not going to be breezed on the lower side, and buying 1420 call around 25 rupees, it can move towards 50-55 rupees also towards this expiry. So this trade can be done. Along with this, another Nifty stock is Dr. Reddy's. So where we have a pair strategy of long Dr. Reddy's and short Nifty, because the reason being, I think the ratio of Nifty to Dr. Reddy's has started declining very fast. So that was near 3.9 for a few months, and then there is a sharp cut towards 3.85. I think the immediate move, the recent move in Dr. Reddy's is going to be little sharper, and that is why it is going to outperform Nifty. Though the last results in Dr. Reddy's was not very encouraging, but now it has already formed a base and it is in a higher bottom cycle. It formed a bottom previously near 1950, then around 2000, and now recently near 2200. So I don't see the stock coming below 2200, and it can move anywhere between 24 to 2500 levels. So I think the recent move can be sharper in Dr. Reddy, looking at the open interest position also, where almost 25% of closure we have seen.